if the U.S. government wants to buy 500,000 coins or something, that only adds to the upside thesis that I already have. I just keep erring toward conservatism in my expectations, which so far has been accurate, but we're only half a year in, so we'll see what happens the next 3.5 years of this particular term. If anything, that's more important is it's empower the people to use Bitcoin in all of its various capacities, more so than the government holding a big stockpile that they can choose to rug people on later. And you always have to assume that whoever owns the Bitcoin now in the government, picture your least favorite politician 10, 20 years from now, they're going to have the Bitcoin. What are they going to do with it? So I'd certainly rather see Bitcoin in the hands of the people.
Lyn Alden, founder of Lyn Alden Investment Strategy, says Bitcoin's behavior in times of crisis often comes down to a straightforward question. Is the event pro-liquidity or anti-liquidity? She points to March 2023 during the U.S. regional banking crisis. At first, Bitcoin dipped. However, as markets began to expect more liquidity injections from the Fed, Bitcoin quickly rallied. Flip the situation though, and the reaction changes. In crises that tighten financial conditions, such as a sharp dollar spike, Bitcoin typically sells off. That's because, compared to almost any other asset, Bitcoin is the strongest correlate with global liquidity. Gold behaves a little differently. It not only responds to liquidity shifts, but it also carries the weight of being a traditional haven. Bitcoin, Alden argues, is slowly moving in that direction. However, it still needs more size, liquidity, and years of institutional adoption before it consistently trades like gold during periods of stress. One of the clearest relationships Alden highlights is between Bitcoin and global M2. Since a significant portion of international debt is dollar-denominated, a stronger dollar reduces liquidity, while a weaker dollar improves it. When global liquidity expands, Bitcoin tends to shine, because unlike equities, it has no earnings component that gets dragged down by weak economic conditions. That makes Bitcoin one of the purest liquidity plays among significant assets. Alden's conclusion is straightforward. If you track global liquidity conditions alongside Bitcoin's position in the hype cycle, you can often get a fairly reliable sense of its next big move. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
I mean, right now, Bitcoin's about the 10th of the size of gold, and it's been around for 16 plus years instead of thousands of years. And there are multiple periods of time where people are always concerned the government was going to like ban it or make it add frictions, get in its way, and so that's part of why it never really had like a safe haven perception, even among people that are deep in the rabbit hole of understanding it. They're like, you can self custody your own money, so they treat it as a safe haven. But in a price action standpoint, big pools of capital wouldn't treat it as such. Being still volatile and still fairly new, I still think it has some ways to go before it reaches that level. Partly it's the way it responds to crises. I pointed out, and I've had debates with some institutional people on this, is that it mostly depends on is the crisis pro liquidity or anti liquidity. So, for example, the March 2023 regional banking crisis, Bitcoin responded quite well after like the initial few hours because the market's immediate reaction was, oh, we're gonna print money for this. And so that was like a pro liquidity crisis. Whereas other types of crises where you get, say, an oil spike or a dollar spike, something like that, even though probably the answer down the road is going to be money printing, it's not necessarily like next day. And so you tend to get a sell off in things and Bitcoin's like the strongest correlate with global liquidity compared to every other asset that I've studied. It's not the only variable that matters for Bitcoin. There are other things. Election outcomes, for example, regulatory changes obviously had a big impact on it. Technical details, just idiosyncratic aspects to the asset itself, but it happens to have a pretty strong liquidity correlation. So that's how it tends to respond to crises. Whereas gold has a hybrid of a liquidity correlation, but also that safe haven status that Bitcoin is, I think, getting there, but not there yet. So I think when it gets bigger, more liquid, more widely held, when it's just been around institutional spaces for longer, I think it can start to bridge that gap and trade more frequently. Like I said, there is a correlation between Bitcoin and global M2. So global M2 is interesting because it takes into account broad money supply from multiple major countries, but then it's tied to dollars. It's basically translated back into dollars, which is relevant because dollar strength matters because there's so much dollar denominated cross-border debt. So when the dollar weakens, that's generally good for global liquidity because it's like if you take out a mortgage in pesos and then the peso goes down, that's good for your your liquidity profile. That's what happens to countries when they take out dollar denominated debts. Now there are like more proprietary things you can do. Like Michael Howell of Cross Border Capital has more sophisticated liquidity measures. The problem is then they're not very transparent. And so we, for that article, we wanted to give something that's just it's open. People can check it. They can check it for themselves. We point out instead of trying to fit to say, if liquidity does this in 3 months, here's what Bitcoin's going to do in 3 months. We weren't getting that granular. The smallest time frame we used was 6 months, but we also looked at 12 months rather than trying to cherry pick specific time frames. And generally speaking, just liquidity is a really big impact on Bitcoin for a couple reasons. One, liquidity tends to correlate with risk on assets, or at least assets that are treated as risk on. So that's Bitcoin equities, things that generally have volatility. Whereas gold and bonds, being more safe haven type assets, don't have a perfect liquidity correlation. If anything, sometimes they're inverse. And then also, but unlike stocks, if you take Bitcoin versus stocks also have the earnings component. So you could have an environment that's good for liquidity but bad for earnings, like kind of a stagflationary environment. And so stocks might not do well, and yet Bitcoin is more purely because it doesn't have earnings. It's an alternative money. It's more trading on that liquidity. And so that's, I think, by almost like by process of elimination, it has the most pure liquidity correlation. And what we generally found is that the exception, so the 17% of the time that it doesn't trade well with liquidity, that tends to be from starting points where Bitcoin is very hyped up. And we used market capitalization compared to realized value or on-chain cost basis. Basically, when there's unusually large dislocations, kind of top of cycle stuff, that's when almost like for the next 6 months, if there's any sort of cracks anywhere, liquidity could be fine, but Bitcoin is just falling from such a hype level. So if you look at kind of those, just one is euphoria in the Bitcoin space, and two, global liquidity. If you combine them together, you're likely to at least do pretty well and protect your downside when trying to forecast probable. Basically, the question is, can digital scarcity have, is it truly scarce? Can it have value? Even if Bitcoin's scarce, will it fracture? And the final piece was, network effects matter. Liquidity is self-reinforcing. Security is self-reinforcing. And the ecosystem of apps and even hardware building on top of it is self-reinforcing. And just like how USB, when it gets in every device in the world, that's pretty self-sustaining, and it can even upgrade gradually over time. So that's kind of the last straw I needed. I was lucky that I have an engineering background, so that weird blend of engineering and macro is kind of, I think, what drew me to it a little bit before other macro people, not as early as some of the tech people, but a little earlier than other macro people.
Mm-hmm.
And like, for example, my part of what catalyzed me to write that 2017 article, even though I'd already heard of Bitcoin, I'd already, I was never really opposed to it. It just wasn't big enough to be on my radar. But I was basically the overseeing the engineering finances of a facility in 2017, and we buy a lot of GPUs at the time, and like all the GPU prices like doubled, and I was like, why is this happening? And like one of our entry level engineers was like, oh, that's the Ethereum bubble. I'm like, what's an Ethereum bubble? So I'm like, I clearly have to. So that was like the early stage of the 2017 run. That was like spring or
Yeah.
whatever. And then so I kind of did a deep dive on it, and so by later that year, I was finally kind of a little caught up on what's actually going on.
Lyn Alden makes an essential distinction regarding Bitcoin's history of wild price swings. Yes, Bitcoin has experienced bubbles in 2013, 2017, and 2020, but she stresses that these were cyclical bubbles, not proof that Bitcoin itself is fake. Instead, they were temporary bursts of overenthusiasm stacked on top of what she sees as a real, growing, and lasting innovation. The same dynamic, Alden explains, can play out with Bitcoin treasury companies. These are firms that hold Bitcoin on their balance sheets. At times, certain stocks tied to Bitcoin have traded far above their fair value, not because of fundamental factors, but due to online hype and investor excitement. As with Bitcoin itself, those mini bubbles usually end in either a correction or a period of consolidation. For Alden, this volatility isn't just noise, it's part of the natural growth path for an emerging asset class. To go from essentially nothing to a multi-trillion-dollar market, Bitcoin has needed phases of extreme upward volatility. But those surges almost always bring in leverage and speculation. And with leverage comes the inevitable downside, sharp pullbacks. Her takeaway is simple: Bitcoin's volatility, both up and down, isn't a flaw. It's the price of progress. If the asset is genuinely on a long-term adoption curve, then cycles of bubbles and crashes are not a sign of weakness, but a feature of how transformative technologies evolve. Let's get back to the interview.
So it's like one of those things, if you ask, was Bitcoin a bubble in 2013, 2017, 2020? Kinda. but only in the cyclical sense. It was a local bubble on top of a structural thing that's real, that's really growing, and actually a new thing that matters. And so I certainly think that you can have a bubble in Bitcoin treasury companies. I think we've had little local ones. I mean, generally speaking, when MicroStrategy would trade well above 3 times MNAV and all on Twitter X, that's all you see people talking about in the space. That's like a local bubble that sets you up for like at least a 6 month, consolidation correction. Had a couple of those. We've had Metaplanet at pretty high levels. It happens. By the time this cycle's done, I wouldn't be surprised if there's maybe an oversupply of less than stellar quality treasury companies coming to market. I mean, we already see this happening in the altcoin space now. Altcoin treasury companies, I think even like NFT treasury companies, or treasury assets. And I think there will be a washout eventually, and that can include some Bitcoin treasury companies if they don't manage their debt well, if they get over their skis. If they don't have protections in place. But it won't be a fundamental bubble. It'll just be over enthusiasm. And the terminology I've used before is that Bitcoin needs upward volatility to reach its potential. That's how you grow from a zero network size to a multi-trillion network size. Anytime you have upward volatility, you're going to get enthusiasm and leverage. So you need just inevitable. You're going to get periods of downside volatility. And we saw that last cycle. I think we probably will see it to some extent this cycle. So far, at least, it's generally speaking more sophisticated actors attaching leverage to it. But that doesn't mean that they're always right. So some of them I think will get caught out. I would eventually like to see more companies with cash flow have a treasury strategy. It's almost like Bitcoiners were waiting for companies to follow MicroStrategy's lead and start adding Bitcoin to the balance sheet, and so few did that Bitcoiners just started making companies to do it. But I would like to see those two kind of come together, where we see a greater number of companies with cash flow, decide to add Bitcoin to their balance sheet, or for new ones to pop up that have a more of a goal of getting some cash flow. With Bitcoin, I mean, it's one of those things where the most successful companies will often look at it as a distraction. So if you're a Mag 7 stock, you're more thinking of, how many tens or hundreds of billions of capex in AI am I going to have to do over the next 5 years? Bitcoin's just a distraction at that point. If you overcommit to Bitcoin and it goes down, then you look like an idiot. If you undercommit, it doesn't matter. I mean, if they put $1 billion into Bitcoin and it goes up to 10 billion, and Bitcoin's $1 million coin, that's a distraction for them because they're so big. So that's just kind of what's on their radar. I think the market that's more ripe for it is companies that like value stocks that are like profitable but like just not growing. And so instead of just always either buying their shares back or just kind of slowly melting, some of them have an asymmetrical opportunity here to buy something that would excite the market and be good for the balance sheet longer term. And then it just comes down to which ones have the vision to do it. We have generally seen, you'll see like these Bitcoin brokers report that a lot of small businesses add Bitcoin to the balance sheet, and that's because they have the situation where the founder just, like either one or a small group of people own the company. They can do whatever they want. They don't have to go through 7 committees to make a decision. And so I think you basically need to see some publicly traded value stocks that are in that side, or you need to see the rise of new companies that are founded by Bitcoiners that come to market and enter more of those value or cash flow type of spaces. Mostly what I focus on the article is trying to basically justify why these companies exist and why they do deserve, in normal market conditions, some degree of premium over NAV. And so the first reason was that they took Bitcoin and put it in an environment where it really wasn't before, which is basically stock managers, bond managers, and all this. And then the second layer of kind of why they exist is that they have access to better types of leverage than most people have. And when you combine longer duration leverage with an asset that has a lot of upside potential, that's kind of rocket fuel as long as it's managed conservatively. I mean, leverage it adds convexity in both ways. And so in this capacity, it actually gives something to institutional capital and to some extent retail capital that doesn't really exist in other packages, and therefore people will generally pay some at least mild premium on a pretty sustained basis for that. You also see, and we talked about fiscal dominance earlier. When you see like a country like, let's say, Turkey or something have a currency crisis, you'll see a lot of companies, like, if they can help it, they'd rather own dollars and then borrow any amount of lira
Yep.
that they can get their hands on, or buy gold and short lira and all that. And so then there's usually restrictions on like credit creation. They'll say you can't, banks can't make loans for these industries or these purposes. Then you get really top down management of the banking system, and it becomes kind of a negative flywheel.
Hmm.
And so we kind of see in developed markets a slow motion version of that, which is you have an asset that is, kind of truly scarce and is going through some degree of tech adoption. If you can attach a fiat currency short to it, and do so conservatively in such a way that you're not caught out by Bitcoin's cyclicality, it really is a value add, especially because certain types of leverage, like you need capital structures or you need scale in order to do that leverage. Liquidity also matters. So having an active options market, having enough volume to do all that is relevant. And so that's, kind of my case for why these companies make sense, at least when bought at appropriate prices.
Lyn Alden makes an interesting point about the role of governments in Bitcoin's future. She says that while some governments may end up accumulating Bitcoin, that's not necessarily the most important factor for adoption. What really matters, in her view, is removing tax barriers on small transactions. For Alden, Bitcoin's real strength comes from being widely distributed among the people, not concentrated in state treasuries. The more decentralized the ownership, the more resilient the network becomes. Patterns of liquidity shifts, speculative surges, and cyclical corrections reveal that Bitcoin's path is far from linear, yet deeply tied to the broader currents of global finance. Its volatility, often mistaken for weakness, may instead represent the natural turbulence of a system still embedding itself into the foundations of modern markets. As institutional depth increases and global liquidity fluctuates, the asset's role as both a speculative engine and a potential reserve instrument continues to evolve. Could the combination of liquidity cycles and adoption trends ultimately redefine Bitcoin's transition from a high beta risk asset into a more established cornerstone of global finance? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.